Ladies and gentlemen, welcome to another episode of Financial Truth Telling, where we pull back the curtain on the confusing world of money. Today, we're tackling a question that many of you may have pondered. When buying a home or any other property, should you pay off the mortgage as quickly as possible, or should you invest the extra money elsewhere? Now, this debate isn't just about numbers. It's about securing your financial future. Let's break this down into a scenario that makes sense. Imagine you have a $300,000 mortgage at a 4% interest rate. Now, you're debating whether to make extra payments to pay off the mortgage faster or to put that money into a side fund. The goal is to see which strategy leaves you with more wealth after 20 or 30 years. Paying off the mortgage faster first. Let's consider paying off the mortgage. The primary advantage here is simple: less debt. By making extra payments, you reduce the principal faster, which in turn reduces the total interest paid over the life of the loan. Now, this can be significant savings. For example, if you can afford to pay an additional $500 per month, you'll pay off a 30-year mortgage in about 20 years, and you'll save about $90,000 in interest. The pros of this situation: guaranteed return. The return on your investment is for sure guaranteed. Paying down a 4% mortgage effectively gives you a 4% return risk-free. You also get peace of mind. Owning your home outright can provide a sense of security and freedom from debt. Improve cash flow. Once your mortgage is paid off, you have more disposable income to invest, save, or spend as you see fit. Now, what are the cons? Well, by putting your extra money into a mortgage, you miss out on the potential higher returns from other investments, so opportunity costs. You also might have liquidity issues, so money tied up in your home is not easily accessible. In times of emergency, it's more difficult to get cash from a home compared to a liquid investment. And then there's tax considerations. Mortgage interest can be tax deductible, reducing your taxable income. Paying off the mortgage faster reduces these deductions. Investing in a side fund, now let's consider the alternative. Instead of putting extra money into your mortgage, you just simply invest it. The key question is, what kind of return do you need from your investments to come out ahead? Well, to outperform the guaranteed 4% return from paying down your mortgage, you would need to earn more than 4% after taxes and fees from your investments. What are the pros of this? Well, potentially higher returns. Historically diversified investment portfolios have returned more than 4% a year. You also have liquidity. Investments in stocks, bonds, or mutual funds are generally more liquid than home equity. And then you have diversification. Investing your money can diversify your financial portfolio, reducing risk. What about cons? Well, there's market risk. Investments come with the risk of losing money, especially in the short term. There's no guaranteed return. Unlike paying down debt, investment returns are not guaranteed. And you have to have some discipline. It can be tempting to spend the extra cash rather than investing it consistently. Let's do some math to see how these strategies compare. Now, assume they have that $500 extra each month, and over 20 years, paying this amount towards your mortgage saves you that approximate $100,000 in interest. Alternatively, if you invest $500 per month in a side fund with a 7% average annual return, you would have around $260,000 after 20 years, assuming the market performs well. However, this comparison changes over 30 years. Continuing the mortgage payments and investing the same $500 monthly at 7% returns in the market could leave you with an approximately $600,000. The extended time allows your investments to benefit from compound interest, significantly outpacing the savings from paying off the mortgage early. Now, when does it make sense to pay off the debt faster? Lower risk tolerance. If you prefer a sure thing and are wary of market fluctuations, paying off the mortgage may be a better choice. Secondly, nearing retirement. Approaching retirement with no mortgage can provide peace of mind and reduce financial burdens. And then, high interest rates. If your mortgage rate is relatively high, paying it down offers a high guaranteed return. When to invest instead? Well, you have a higher risk tolerance. If you're comfortable with the ups and downs of the market, investing can yield higher returns over the long term. You have a long time horizon. Younger individuals with decades until retirement can benefit more from the compounding growth of investments. And lastly, emergency fund. Having liquid assets available in an emergency is crucial. So in the end, the decision comes down to personal preference, financial goals, and risk tolerance. If the thought of debt keeps you up at night, well, paying off the mortgage might be worth the peace of mind. On the other hand, if you're comfortable with the risk and have a long-term horizon, investment might provide greater wealth accumulation. In either case, maintaining a balanced approach and regularly reviewing your financial situation with a professional advisor can ensure you make the best decision for your unique circumstances. Remember, it's not just about the math. It's about what helps you sleep better at night. Thank you for tuning in today. If you found this information useful, please like and subscribe before you go. And as always, keep doing life better.